Thanks, Rich. Hi, everyone. Today I'm going to walk us through some of the financial statement considerations when accounting for PPP loans. So the AICPA has released guidance that has identified 4 models that could potentially be used to account for PPP loans. We have the debt model, the government grant model, the IAS 20 model on government assistance, and the gain contingency model. Today I'm going to focus the discussion on the debt model and the government grant model, since we believe these will be the most commonly selected accounting policies. Now, if you've done your homework and have questions regarding the IAS 20 model or the gain contingency model, please feel free to submit those, and we'll do our best to get back to you at the end of the webinar. So the debt model isn't too complicated. As you can imagine by its name, if you're using the debt model, the accounting treatment of the PPP loan is going to look a lot like the accounting treatment for other forms of debt. The initial receipt of the proceeds are going to be recorded as a liability and are going to remain a liability until the loan is forgiven and you've been legally released of the obligation, or you pay off the loan to the creditor. Now, interest would be accrued at the rate of 1%, which is included with all PPP loans. However, it's important to note that you would not need to impute a market rate of interest, since the guidance on imputing interest excludes transactions where rates are prescribed by a government agency. So once the loan or a portion of it is forgiven and legal release is received, the entity would reduce the liability by the amount forgiven and record a gain on extinguishment, which would be included in non-operating income. So let's talk a little bit about some cash flow considerations. Money received under the PPP loan is going to be reported as a cash flow from financing sources. Principal payments, if any are made, would be reported as a cash outflow from financing activities. Interest payments are going to be reported as cash outflows from operating activities. And any portion of the loan that is forgiven would be reported as a non-cash financing activity. Any interest that is subsequently forgiven is going to be shown as a reconciling item between net income and cash flow from operations. A few more things to consider with the debt model. It's available to both nonprofit and for-profit entities. It's a less risky approach because it removes a lot of the judgment that other approaches require. As I said before, the debt model is pretty straightforward. Your proceeds, when you receive them, are going to be a liability until you legally are released of the obligation or you've paid off the loan to the creditor. So the debt model might be more appropriate for your entity if you are unable to establish that you can meet a no more than remote threshold for repayment of the PPP loans due to uncertainties about meeting conditions for forgiveness or incurring eligible expenses. Now, the next model is the government grant model. To give you a quick background here, the government grant model stems from Accounting Standards Codification 958-605, which is specific for nonprofit entities. However, because US GAAP does not specifically address how a for-profit business entity should account for the government grants that are not in the form of a tax credit or are not considered revenue from contracts with customers, the AICPA has released guidance saying a for-profit business entity can use the government grant model as well. So under the government grant model, conditions for forgiveness should be substantially met before the receipt of assets is recognized as revenue. Therefore, the initial receipt of the PPP funds is considered a conditional contribution and should be accounted for as a refundable advance on your books, which is a liability, until the conditions for forgiveness have been substantially met. So examples of the conditions you want to consider here are maintaining your full-time equivalent numbers and maintaining those salary levels, and then also incurring qualifying expenditures. So how would this work? If your entity determines that you're going to meet the guidelines for forgiveness, they would recognize revenue when they incur the qualifying expenses. For a nonprofit, this revenue would be called grant income on your financial statement. For a for-profit business entity, this would be considered non-operating revenue, similar to the terminology used for the debt model. It's important to note that for a for-profit business entity, there's no requirement to use the label grant or contribution revenue. Alternate descriptions such as PPP loan forgiveness or PPP grant would be acceptable as well. Some entities now may prefer this method because you're matching your revenues with your expenditures. What I mean by that is under this method, since you are recording the revenue as you incur the expenses, this is keeping your revenues and your expenses in the same reporting period. Interest guidelines are pretty simple. You would not accrue interest on any amounts that are expected to be forgiven, since it is not considered debt. You would, however, accrue interest on any portion that is anticipated to be repaid. Cash flow considerations, again, pretty basic. Any amounts expected to be forgiven are reported as operating activities. Any amounts not expected to be forgiven are reported as financing activities. A few other things to consider with the government grant model. You should not be netting revenues and expenses from the PPP loans. These are going to be reported gross on your financial statements. You should not be grouping any PPP revenues with any revenues covered under ASC 606, which is standard for revenues with contracts from contracts with customers. This method is also available for both for-profit and nonprofit entities. And it's important to note, again, compared to the debt model, this introduces more risk because you're identifying conditions, you're using judgment to identify conditions, and also then determining if those identified conditions have been met in order for you to recognize revenue. So a for-profit entity might choose this method if they have a high level of confidence in their ability to be an eligible recipient and to meet conditions and to meet the conditions of the loan. Thus, it would be able to conclude that all the relevant conditions for forgiveness, your qualification, your certification, and qualifying expenditures have been substantially met. Taking a look at financial statement disclosures, you will be required to disclose the accounting policy you've selected, whether that's the government grant model or the debt model or one of the other two models we haven't discussed in depth today. Depending on the model you select, your disclosures could vary, but they're likely to include the amount of funds you received under the PPP program and where those funds are reported within your financial statements. So for example, your disclosure might read, the entity has received $100,000 in PPP funds. Of this amount, $50,000 were recognized as revenue on the government grant model in the reporting period, and $50,000 remain reported as a liability at year end. And then additionally, entities are going to have to consider the disclosure requirements of the specific guidance you've selected. So if you choose the debt model, your disclosures will look similar to other debt disclosures where you're disclosing terms of debt and future maturities. A couple of final considerations here. The PPP loans are not subject to single audit implications. So quick background, a single audit, if a non-federal entity expends $750,000 or more of federal awards in a fiscal year, they would be subject to a single audit. However, guidance came out that clarified that PPP loans, while they are federal funding, they're not subject to single audit implications. So they're not going to count towards that $750,000 threshold. It's important to note, however, that there are other COVID-19 relief funds that are subject to single audit implications. So you're going to want to look at your grant documentation if you're receiving any of these other funds and make sure you take that into consideration for your planning. Also, there's no double dipping. So what I mean by that is if, for example, you're a nonprofit, you're not permitted to use PPP loans or PPP funds for the same expenses that are being paid by other government agencies. So if your organization submits payroll costs for reimbursement to a government agency, these same costs cannot also be submitted for PPP forgiveness. And then finally here, I include mention of the most recent IRS revenue ruling 2020-27. This was just recently released. It's providing more guidance that reaffirms that expenditures covered under the PPP loan that are reasonably expected to be forgiven are not deductible for tax purposes. And this would include a situation where the expenses are paid in 2020, but forgiveness is not formally granted until a future year. Now, this situation is fluid. Expect to hear more about this in the news. Expect to hear more about it in our presentation today. However, I just wanted to mention it here in the financial statement section for any business entities that pay tax at the business entity level and thus are calculating a tax provision to be reported on their books. That's everything that I have today for financial statement considerations. If you have any questions, please feel free to submit them and we'll do our best to get back to you. Thank you.